Let's Talk Money.
Welcome back. You're with us on the election special edition of Let's Talk Money. A lot of you have been asking us what to do after this mega poll verdict. So we've got some questions on, I think, the kind of funds one can look at. Aman is with us on the line, so let's go to him first. Aman, hi. Welcome to the show. Tell us, what's your question?
So my question is, currently market is down by 5 to 6%. Where can I invest my money in equities? Should I do lump sum or SIP? And what mutual funds can I invest?
Okay, I think it's a question that also resonates with a lot of other viewers, which is why I'll quickly take one more query, which is very similar to yours, Aman. Rohit's question is also similar. He's saying which mutual funds, but he's got a long time frame, 5 to 7 years. So he's a very patient investor. So Ashish, just start on this because these are questions on equity specifically. How should one, let's start from the basics. If you were to construct an equity portfolio right now for people, what all funds would go in it?
So I think flexi-cap funds is what we are recommending, given that they have the ability to move across market caps and adapt to the underlying themes. So we like the HDFC flexi-cap fund, we like the ICICI Approved Opportunities Fund, we like the Parag Parikh fund as well, and the Motilal Oswal mid and large cap fund.
Okay.
Right? These are funds. I mean, most of these funds have been around for a while. They have demonstrated long-term track record, and they have the ability to move across sectors and market caps. So these are the funds I would say that he should look at. In terms of the approach to investing, we believe that an SIP approach is best at the moment, or a staggered approach over the next 6 to 12 months, because it's still an event-heavy year. Right? Okay. You have multiple Fed meetings, you have the US elections, and there are elections across the world. So it's going to be a very, very event-heavy calendar. And after the elections, now you have the budget. So there'll be enough volatility. So there's no need to rush in and put in lump sum. You can stagger your investments, and you can put a rule. Every time the market tanks 5%, you could probably, advance 2 months of your installments immediately.
Okay, so those are the flexi cap names. Anything else in large cap?
So in large cap, we like the Quant Large Cap Fund, the HDFC Top 100 Fund. I mean, these two have been in our stable now for a long time.
And any reasoning? I mean, Quant is a completely different sort of ball game. Their funds have done well, different approach and strategy there.
So they've been very nimble-footed, and they've moved across stocks and sectors quickly. And this large cap fund basically restricts them to the top 100 stocks. Okay. So in a sense, it's a stable kind of area to give them money.
Okay, fair enough. So those are some of the the funds on the equity side. Radhika, also we haven't spoken about fixed income, but that's also really important, right? When we talk about asset allocation, what is? I mean, personally for you, I know this is a very personal question to each investor, but for someone with a medium risk appetite, if you say you talk about yourself, or if you tell me what to do, what should be the ideal asset allocation?
So I think asset allocation is super personal, and I think it really depends on circumstances. I have personally been 60-40 equity fixed income. I've taken it up to 80-20 equity fixed income. And I really think you need to break down money into time horizons. Money that's more than 5 years is really equity money, and money that's 3 to 5 years, I think, is hybrid money, and less than that is fixed income money. In this tax regime, and I know that we may have, we have a budget ahead, but at least in this current tax regime, if I were to allocate to fixed income, I would allocate it via a hybrid fund. So as an example, if I wanted to do 70-30 equity debt, I'd rather do it in an aggressive hybrid fund, or I'd rather do it in a balanced advantage fund, because you're paying equity taxation rather than the full taxation on your entire 100 rupees of investment or whatever it is. So I think actually in today's era with so much event in uncertainty, one approach is to SIP, STP into equity funds, but even doing lump sum deployment into hybrid funds that are doing that automatic allocation is a good way to take equity exposure, but also manage fixed income and manage the volatility and upside.
Okay. And again, just to remind our viewers on the taxation, but not all hybrid funds enjoy equity taxation, right?
Which is why I mentioned specifically two categories, balanced advantage and aggressive hybrid. Balanced advantage, people rotate between 30 to 80, but they have arbitrage in the balance. Aggressive hybrid, people are typically 65 to 70% equity. So both of these funds, for most AMCs or all AMCs, will have equity taxation status. So even on that 35%, which is fixed income, you are paying much lower tax rates.
Okay. Ashish, you also mentioned that you've really liked multi-cap or multi-asset funds as a strategy, right? That's been your house call from the start of the year.
Right.
Any specific names, any MCs you like here, or are most of the multi-asset
There are
funds
two
similar?
that stand out. One is the iPru multi-asset fund and the recently launched White Oak, because they're true to mandate and give you exposure across the asset classes that we are bullish on. So I think they'll be able to manage risk, and it'll also give you stability in your portfolio. So I'm a very strong proponent of substituting debt with multi-asset funds. Of course, there are people who like to have debt also in their portfolios, because like she said, it really depends on your time horizon and when you need the money. Multi-asset funds, basically, I would recommend for 3 years plus.
Okay, so 3 years plus. There we go. We've got, I think, plenty of ideas that people can work with, can go back and do their own homework. Final thoughts coming back down to brass tacks. So what are the lessons, Radhika? And now from here onwards, as we navigate all the events that Ashish was talking about, what should investors really keep in mind?
One is, I don't think they should lose their conviction in the India story, because there's a lot of narrative that has happened. And I do believe that, the Indian economy, I always give this statistic, in the last 40 years has doubled every 6 years since 1980s. We've had all kinds of governments in power. We've had coalition governments. So I don't think people should lose their faith in the India story. And now that doubling is happening at a 4 trillion size. So I think that's one lesson. Second, I reiterate the lesson around the middle path, that people should swing away from extremes. These two things. And third, if you're panicked during extreme event days like this, don't take any action. Wait. Not a lot of answers have to be found on day 1 or day 2. As he said, there'll be cabinet formation, there'll be a budget. You can wait. Nothing is running away anywhere.
Okay. Ashish, final golden tip?
Yeah, so I think these days, bring you back to basics, right? Often you do get carried away in markets which are very frothy, and you also get carried away on the other side when markets are bad, right? And I always say that India disappoints the optimist and surprises the pessimist, okay? So there is an inherent growth in our economy. So I think people should trust the future. There is a lot of money to be made over the next 5, 10, 15 years. I think we are in a structural, longer term, bull market for the economy, and that should translate into stock markets as well. But at the same time, like we discussed, any thematic positions or, getting carried away, etc., try and do it on 10 to 20% of your portfolio. But your main portfolio should be bread and butter, which is, asset allocation. Within that, have a good diversification across funds. Stick to staple funds like flexi cap funds or large cap funds, and I think you should do fine. So these days are just a reminder that not to get carried away, and basics work, and just stick to them.
Okay, stick to the knitting and keep your eye on the ball. All right, thank you very much both. It's been really, really helpful, and I'm sure our viewers are going to take home a lot of these points as they look forward to their money-making strategies, investment strategies in the weeks and months ahead. Thank you for joining in today and taking the questions.
Thanks.
Thank you.
Thank you.
Well, with that, we're out of time on this episode of Let's Talk Money. Remember, keep sending us your feedback, your comments, your queries, and we'll see you again with another conversation next week. Thanks for watching.
Let's Talk Money